Hey everyone, and welcome to The Explainer. I am absolutely thrilled you're joining us. Today, we're putting on our sell-side equity analyst hats and diving into a rigorous, fundamental valuation of Fulton Financial Corporation, trading under the ticker FULT. We're going to rely entirely on documented financial metrics from their latest filings to see if we can uncover the true intrinsic value of this regional bank. We'll look at the cash flows, the dividends, and even the missing data to build a complete, disciplined picture. Let's get right into it.
I want to anchor you right out of the gate with this massive number, 42.63%. In the world of equity valuation, we call this the margin of safety. Basically, it's the cushion between what a stock is currently trading for on the open market and what our fundamental models suggest it's actually worth. Guys, a margin of safety over 40% is literally huge. It screams that either the market is completely missing something incredibly valuable, or our models are trying to catch a falling knife. Today, we're going to investigate that exact valuation gap.
Okay, let's dive into this. Here is our analytical roadmap. We'll start with an executive summary, hit the DCF method, check out the dividend model, look at market multiples, touch on advanced models, and then bring it all together in a final synthesis.
All right, starting with Section 1, our executive summary. Let's establish this valuation gap.
So here's the absolute crux of the situation. Right now, based on the provided data, Fulton Financial is trading at $21.79 a share. But our calculated fair value price, that sits way up at a robust $37.98. We are looking at a disparity of over $16 a share. Our job as rigorous analysts today is to really test this gap. Is this a true generational buying opportunity, or is it just a value trap in disguise? We're going to let the documents and the math decide.
Moving right along to Section 2, absolute valuation, where we crack open the DCF method. Just so we're all on the exact same page, a discounted cash flow, or DCF, is our gold standard for absolute valuation. We forecast the unlevered free cash flows the company will generate, and then we discount them back to what that money is worth today using a risk-appropriate discount rate. It's the ultimate reality check for any stock.
Now, when we actually run the DCF for Fulton Financial, we get two wildly different intrinsic values depending on our baseline metric. If we model using free cash flow, the fair value is $27.71. But if we base our model on earnings per share, it leaps all the way up to $37.98. Now, both of these handily beat the current $21.79 market price, but we have to ask ourselves, why in the world is there a $10 difference between our own two models?
Well, this beautifully illustrates exactly why the free cash flow model yields a much lower, more conservative fair value. Take a look at the historical cash flow growth. It has been incredibly volatile. The trailing 12 months looks amazing at almost 36%, but the 3-year and 5-year compound annual growth rates are deep in the red. As disciplined analysts, when we see wild swings like this, we absolutely have to apply conservative growth constraints in our models, which gives us that lower $27.71 free cash flow value.
Let's flip over to Section 3, absolute valuation, using the dividend discount model.
Now, the dividend discount model, or DDM, approaches valuation purely from the perspective of direct shareholder returns. It assumes a stock is basically worth the sum of all its future dividend payments discounted back to their present value. It's an exceptionally powerful tool, but there's a catch. It only really works if the company has a rock-solid, consistent dividend policy stated right there in their filings.
And wow, look at how clearly this data establishes that reliability for FULT. Unlike those volatile free cash flows we just saw, their dividend growth is just a picture of steady, beautiful acceleration. You've got a 5-year compound annual growth rate of a healthy 6.29%, accelerating to 8.18% over the last 3 years. That smooth, predictable climb makes the DDM a fantastically robust tool for this specific stock.
Plus, check out the underlying health of that dividend. Fulton offers a very solid 3.49% yield, but more importantly, their payout ratio is only 34.74%. That means they are only paying out about a third of their earnings, leaving a massive cushion for operations and future hikes. Combine that low payout ratio with an impressive 11 straight years of dividend increases, and we've got absolute confirmation of a reliable policy. It perfectly sets the stage for our multi-stage DDM application.
All right, shifting gears to Section 4, relative valuation via market multiples.
When we take a step back and systematically compare Fulton's current valuation multiples against its own 3-year historical baseline, a really interesting pattern pops up.
The current PE is 10.38 compared to a 9.90 average. Price to book is 1.11 versus 1.00. Across the board, PE, price to book, EV to sales, the current multiples are running slightly hotter than their medium-term historical averages.
To put a precise number on it, that current PE of 10.38 actually represents a 4.79% premium over its historical average. And this is a really fascinating contrast, right? Because on an absolute basis, looking at cash flows and earnings, the stock looks massively undervalued. But on a relative historical basis, the market is actually pricing FULT at a slight premium to its norm. That is exactly the kind of nuance we need for a complete analyst report.
Moving right into Section 5, Data Constraints and Advanced Models.
Now, as rigorous analysts, we rely entirely on the documents provided. We completely refuse to invent inputs out of thin air. And because of that, we hit a few constraints here. We can't do a sum of the parts valuation because the filings are missing distinct segment-level operating data. We can't build an adjusted present value model to accurately value tax shields without specific debt schedules. And an expanded liquidation value, that's out of reach too, since we don't have fair market restatements for those individual balance sheet assets.
But I really want to emphasize this point. Acknowledging these blind spots doesn't weaken our explainer, it literally strengthens our analytical discipline. By clearly stating what we don't know, it gives us immense confidence in the absolute models we did successfully execute. We know we didn't force the math on those advanced models just to fill out a spreadsheet.
And finally, Section 6, Synthesis. Let's bring all this data together to determine the final intrinsic value.
So, the crucial point is this. The market prices FULT at $21.79 today, but our most conservative model, that free cash flow DCF, constrained by historical volatility, prices it at $27.71, and the EPS-based DCF values it at $37.98. Notice the trend here? Every single fundamental absolute model we ran prices this stock significantly higher than what you'd pay for it on the open market today.
Which completely validates that gap we talked about at the very beginning of this explainer. When you strip away the emotion and just look at the documents, blending those earnings and cash flow realities, you're looking at a company fundamentally worth somewhere near that $38 mark, but trading for far, far less. Which brings us full circle right back to our hook metric, 42.63%. Even when we transparently factor in our data constraints on those advanced models, and even knowing FULT is trading at a slight premium relative to its own 3-year history, that base case margin of safety is still just massive. The cash flow and earnings metrics heavily support a deep discount in the current share price.
So, I want to leave you with this final provocative thought to chew on. Given the rigorous, structured framework we just walked through, does a 42.63% margin of safety compensate for the data limitations in our advanced segment and liquidation models? As an analyst, you've got to weigh that incredible absolute value against the slight relative premium and the unknown segment risks. I highly encourage you to take this documented, disciplined approach and apply it to your own future analyses. Thanks so much for joining me on this explainer, and keep digging into those numbers.